Welcome to Investors Insight, where today's topic is the bond market flexes its muscles. Guys, volatility really came back strong last week as interest rates hit a 7-year high. We do think hopefully there's a light at the end of the tunnel here with earnings season kicking into gear. We expect double-digit growth, hopefully, and so that kicks into gear Friday with the biggest financial firms reporting earnings. Trey, tell us more about the bond market and all the volatility, why it's happening.
Yeah, James Carville famously said in the back in the 1990s that if he dies, he'd like to come back as the bond market because it was more powerful than the president. I'm not sure if that's definitely true, but we saw the power of the bond market last week with several statements from the Federal Reserve Chairman. We saw interest rates move up for the first time in several months. We saw them move up quickly, like you said, highest in 7 years. The 10-year Treasury moved up only 17 basis points. It seems like a very small amount, but that was enough to cause some equity markets to be down as much as 4%. And as long as interest rates seem to be volatile, I think we're going to see a lot of volatility in the stock market. So, the bond market roared and the equity market seemed to cower.
Yeah, definitely. There was good news, though, as the unemployment rate tick lower. Adam, tell us about that.
So recently we've been talking about employment numbers and employment reports coming out. In September, they reported that 23,000 jobs have been added to construction hiring. This number is 315,000 higher than the point in last year. This construction hiring spree that we're on in the last 5 years is the second strongest in history.
That's some really strong numbers, and I know we're seeing that kind of economic wide. That may be why interest rates have been moving up.
Yeah. Not only in construction, it's short in trade everywhere, basically in trade jobs. But that's good data.
Yeah, and absolutely. And in addition to that, 273,000 jobs are still open. So the market is still flooding in. Workers are still coming into the force.
Yeah, and then actually tell us more about the unemployment rate again. Really good, strong number last week, and really kind of a bright spot.
Well, it's historical, and we looked at that a little bit and had some questions on this. And the questions were, how low is this relative to history, and how long, more importantly, how long can we sustain it? And we looked at that, and if you go back to 1950s Korean War era, we've had 4 times in our modern history in the United States where we've had unemployment rate at this point or lower. Right after the Korean War was one. The one you've heard about in the comparison during the Vietnam War in '69 was one. The third was right before the tech bubble, and the fourth is now. So in looking at that, can you look at the history and glean a little comparison? Yes, you can. The low unemployment rate in the Vietnam War did not sustain itself because there was a lot of inflation there. It was about 6 to 8%, and the inflation just quickly undid that. The tech bubble was just short. You just took out a lot of sector hiring in tech right before 2000. So those are both kind of one-offs. But after the Korean War, we had a sustained expansion. This one looks a lot more like that. It's not a one-off like Vietnam, or it's not a one-off like that the tech bubble was. And the Federal Reserve predicts possibly that we could drive the unemployment rate down even farther in 2019 and sustain this out into 2021 because we don't have negative factors that are overwhelming.
We don't have a lot of inflation.
No, we had inflation of the tech bubble. Yeah, so this could go on for a while, which is good.
Yeah. So as the volatility continues, please call us or email us or come see us. We want to make sure you're sleeping at night. We're watching your portfolios carefully. Thanks for watching.